Hello and welcome to this video on The Bogleheads Guide to Investing by Michael LeBoeuf. In this video, we will provide an overview of the book, discuss its key principles and steps, provide examples from the book, and conclude with a summary of the content. Investing can be a complex and intimidating topic, but The Bogleheads Guide to Investing makes it easy to understand and implement. The book is based on the investment philosophy of John Bogle, the founder of the Vanguard Group, and provides readers with a step-by-step guide to investing. Whether you are a seasoned investor or just starting out, this book is an essential resource for anyone who wants to learn about investing and how to manage their finances. So sit back, relax, and join us as we explore the world of investing with The Bogleheads Guide to Investing by Michael LeBoeuf. The first principle of The Bogleheads Guide to Investing is to invest early and often. This means starting to invest as early as possible and making regular contributions to your investment portfolio. By investing early, you can take advantage of the power of compound interest, which allows your investments to grow over time. For example, if you invest $1,000 at a 7% annual return, your investment will be worth $1,070 at the end of the first year. If you reinvest the $70 and continue to earn a 7% annual return, your investment will be worth $1,145.90 at the end of the second year, and so on. Over time, the power of compound interest can lead to significant growth in your investments. In addition to starting early, it is also important to make regular contributions to your investment portfolio. This means setting up automatic contributions from your paycheck or bank account, so that you are consistently adding money to your investments. By investing regularly, you can take advantage of dollar cost averaging, which allows you to buy more shares when prices are low and fewer shares when prices are high. Overall, the first principle of The Bogleheads Guide to Investing emphasizes the importance of starting early and investing regularly in order to take advantage of the power of compound interest and achieve long-term growth in your investments. The second principle of The Bogleheads Guide to Investing is to invest in low-cost index funds. This means investing in funds that track a broad market index, such as the S&P 500, and charge low fees. The Bogleheads investment philosophy is based on the belief that most investors are better off investing in index funds rather than trying to beat the market through individual stock picks or actively managed funds. This is because index funds provide broad exposure to the market at a low cost, which can result in higher returns over the long term. In contrast, actively managed funds often charge higher fees and try to beat the market by selecting individual stocks or timing the market. However, research has shown that the majority of actively managed funds underperform their benchmark index over the long term, making it difficult for investors to consistently beat the market. By investing in low-cost index funds, investors can benefit from broad exposure to the market and lower fees, which can lead to higher returns over the long term. For example, if an investor invested $10,000 in an S&P 500 index fund with an expense ratio of 0.05%, or $5 for every $10,000 invested, they would pay only $50 in fees per year. In contrast, an actively managed fund with an expense ratio of 1%, or $100 for every $10,000 invested, would cost the investor $1,000 in fees per year. Overall, the second principle of The Bogleheads Guide to Investing emphasizes the importance of investing in low-cost index funds in order to benefit from broad market exposure and lower fees, which can lead to higher returns over the long term. The third principle of The Bogleheads Guide to Investing is to diversify your investments. This means spreading your investments across different asset classes, such as stocks, bonds, and real estate. Diversification is important because it can help reduce the overall risk of your investment portfolio. By spreading your investments across different asset classes, you can reduce the impact of any one investment on your portfolio. For example, if you only invest in one stock and that stock performs poorly, your entire investment portfolio will suffer. However, if you invest in a variety of stocks, bonds, and real estate, the poor performance of one investment is less likely to have a significant impact on your overall portfolio. In addition to diversifying across different asset classes, it is also important to diversify within each asset class. This means investing in a variety of stocks, bonds, and real estate investments, rather than just one or two. For example, within the stock portion of your portfolio, You may invest in a variety of industries, such as technology, healthcare, and energy, rather than just one. Overall, the third principle of the Bogleheads Guide to Investing emphasizes the importance of diversifying your investments across different asset classes and within each asset class in order to reduce the overall risk of your investment portfolio. The fourth principle of the Bogleheads Guide to Investing is to minimize taxes and expenses. This means being mindful of the taxes and fees associated with your investments and taking steps to minimize them. One way to minimize taxes is to take advantage of tax-advantaged investment accounts, such as 401(k)s and IRAs. These accounts allow you to invest money pre-tax, which can reduce your taxable income and lower your tax bill. Additionally, any investment gains within these accounts are tax-deferred until you withdraw the money in retirement, allowing your investments to grow tax-free. Another way to minimize taxes is to invest in tax-efficient funds, such as index funds, which tend to generate fewer capital gains than actively managed funds. By minimizing capital gains, you can reduce the taxes you owe on your investment gains. In addition to minimizing taxes, it is also important to minimize expenses associated with your investments. This means choosing low-cost investments, such as index funds, and avoiding high-fee investments, such as actively managed funds or individual stocks. By keeping your investment expenses low, you can increase your overall investment returns. Overall, the fourth principle of the Bogleheads Guide to Investing emphasizes the importance of minimizing taxes and expenses associated with your investments in order to maximize your overall investment returns. In conclusion, the Bogleheads Guide to Investing is a comprehensive and practical guide to investing that provides investors with a solid foundation in the principles of sound investing. The 4 principles outlined in the book: develop a sound financial plan, invest in low-cost index funds, diversify your investments, and minimize taxes and expenses, provide a framework for building a successful investment portfolio. By following these principles, investors can benefit from a long-term approach to investing that is based on evidence-based research and proven investment strategies. The book emphasizes the importance of avoiding the pitfalls of trying to time the market or pick individual stocks, and instead focuses on the benefits of investing in low-cost, diversified index funds. Investing can be a complex and confusing topic, but the Bogleheads Guide to Investing provides a clear and concise roadmap for investors of all levels. Whether you are just starting to invest or are a seasoned investor, this book can help you build a sound investment strategy that will help you achieve your financial goals over the long term.